Chapter 1, Introduction to Accounting and Business, Illustrative Problem, Part 2. Please turn your pages to 25, 26, and 27 in your textbook. That way you can follow along and, if you like, work out the problem along with me. In the first video, we recorded the transactions that affected the accounting equation for Cecil Jamison, attorney at law. We did transaction A through K on page 25. We entered those transactions into the accounting equation, assets equal liabilities plus owner's equity. And then after all transactions were entered, we balanced every account. So on page 26, you can see that the balance of the cash account, $6,873. Accounts receivable, $2,225. Supplies, $980. Land, $10,000, so on and so on. Now what we're going to do is we're going to take the balances of the accounts, we're going to put them in the financial statements that they belong to, and then we're going to determine what was the net income for the company, did the owner's equity increase or decrease, we're going to do a balance sheet, and then last we're going to talk about a statement of cash flow. So you may follow along with me on a blank sheet of paper if you like. And that way you will be able to understand what we're doing. Alright, so on page 26, we need to do the income statement for Cecil Jamison. So the first thing you need to do is put a title on every financial statement. It's very important. I have multiple clients, so if I don't put the title of the company on the financial statement, then I don't really know who it belongs to. So it's very important that you put the name of the company, the name of the financial statement, in this case it's an income statement, and for what period it's for. This particular financial statement is for the month ended July 31st, 2013. Once you get the title in, then we can begin building the financial statement. So the first financial statement you're going to build is an income statement. And on an income statement, we see that revenue minus expenses equals a net income or a net loss. So for the income statement, we are going to have revenue minus expenses equals net loss or net income. Preferably, we're going to have a net income. Alright, so if revenue is more than expenses, you're going to have a net income. If revenue is less than expenses, you're going to have a net loss. Ideally, we're going to have a net income because that means that we retained money after paying expenses. Alright, so let's look and see how this applies to Mr. Cecil's company. Alright, so when we're building the financial statement after we put the title in, first thing we're going to start with is revenue. And in this particular company, there's only one revenue account. It's called Fees Earned. So we're going to start right here, all the way at the left-hand side, and we're going to write in Fees Earned. That is the revenue account. And we're going to come all the way out to the right-hand side, and we are going to write $5,900. I had to erase. We're going to write $5,953. Alright. Now, since we don't have any other revenue accounts, we're now going to list the expenses. So we're just going to indent just a little bit. We're going to write the word expenses. And then right below it, we're going to list all expense accounts individually. We list all expense accounts in the order of greatest to least, with miscellaneous always being listed last. So the greatest expense that we have right now, the largest expense we have, is the paralegal expense. So we're going to start with that account. Paralegal expense was $1,635. Notice I'm on the inside column. The next largest expense we have is the rent. So we're going to do rent expense. And that was $1,200. Okay. The next expense is wages expense. And it is $850. And then we have utilities expense. And that is $325. Then we have the answering service expense. And that was $250. Then we have supplies expense. Remember, supplies expense is the account that we create after we use some supplies and we determine the value of what we used. We convert it over to supplies expense. That's considered to be an adjusting entry. And last, we have miscellaneous. And that was $75. All right. Once we have all the expense accounts listed, we're then going to do total expenses. And we're going to total all of the expense accounts. We're going to put that total out here on the far right column. So $4,450 is the total expenses. And then I have to determine, did the company have a net income or net loss? Well, in this particular case, the revenue is higher than the total expenses. So we are going to say that this is a net income. So we're going to write net income we're going to put that total, 5,953 minus 4,450 equals $1,503 net income for the company for the month of July. So revenue earned, 5,953, total expenses, 4,450, resulted in a net income of $1,503. Now that we have completed the income statement, the next statement that we need to complete is the statement of owner's equity. This particular statement indicates whether or not the owner's equity increased for the particular month. So we're going to prepare the statement of owner's equity for Cecil James, Attorney at Law, putting the name of the company, the title of the statement, and for the month ended July 31st, 2013, just like on the statement of income. Now, for a statement of owner's equity, we have a couple of things we need to remember. I'm going to write them down for you. You can kind of follow along and take notes. All right, so statement of owner's equity. I do OE for abbreviation. I'll take that abbreviation. All right, so the first thing we do is we start off with beginning capital. Sometimes this will be obvious because you'll have worked on the problem already, or they'll state it in the directions what the beginning capital was, or you'll also see it in the accounts that are listed. The next thing we're going to add in any additional investment, if there is one. There's not always going to be an additional investment. We're going to add in or take away a net income or loss. We're then going to take away any withdrawals that the owner may have done, which is the drawing. And then we're going to determine whether or not there was an increase or decrease in equity for the month. We're then going to take the beginning capital, add it to the increase or decrease to determine what the ending capital for the month is. Now, notice that I said we're going to add in net income. Well, where do we get the net income for the company? We get it from the financial statement we just prepared. And in this case, the net income was $1,503. So we're going to use that when we do the statement of owner's equity. All right, so let's get started. The first thing we're going to do is we're going to list Cecil Jameson capital for the beginning of the month. So we're going to do Cecil Jameson capital for July 1st, 2013. And we're going to come all the way out here to the right-hand column, and that is $13,520. Where do we get that information from? The transactions we just recorded? On page 26, if you look all the way at the top, before we did transaction A, you see that the capital for Jameson is $13,520. The next thing we're going to do is we're going to add in any additional investment. And for this particular month, Cecil Jameson actually added in an investment for $3,700. So we're going to enter this into this financial statement. So we're going to write additional investment. And we're going to write it right here, $3,700. Okay. We're then going to add in the net income, and remember that was $1,503. So we're going to bring that down here. We're going to do net income for the month. $1,503. All right, then we're going to draw a line. It means we got to do a calculation. What we're going to do is we're going to add these two together, $5,203. Then we're going to take away the drawing. So we're going to do less withdrawals. In this case, it's $1,000, so we're going to put 1,000. And then we're going to draw another line because now we have another calculation to do. And this is where we're going to determine, was there an increase or decrease in what happened for this particular month with the investment, the income, and the drawing. So I've determined that with the investment in the net income, we had $5,203, and the owner only withdrew $1,000, which means that the owner's equity actually increased for the month of July. So we're going to write increase in owner's equity and we're going to come all the way out here, $4,203, and draw another line. Now we need to determine what is the ending capital. Then we're going to take the beginning capital, add in or take away the increase or decrease in equity to determine the ending capital. So we're going to write Cecil Jameson capital as of 7/31/13 is now $17,723, and we're going to double underline it. Double underline tells me as an accountant that that is the final balance that I'm looking for. All right, so Cecil Jameson's equity increased for the month of $4,203, bringing his ending capital to $17,723. This particular total is going to go to the balance sheet. So now that we've created the statement of owner's equity, the next financial statement we need to create is the balance sheet. The balance sheet will seem a little familiar to you because it goes along with the accounting equation. So for the balance sheet, what we need to collect is the information that relates to assets, liabilities, and owner's equity. However, for this particular owner's equity, this is strictly the ending capital that comes from the statement of owner's equity. right, so we're going to list all assets, liabilities, the capital account from the statement of owner's equity, and this should equal, assets should equal liabilities plus owner's equity. So let's see how this works for Mr. Jameson. All right. Okay, so if you look on page 26, you will see the accounts again listed that we've been using to build the financial statements. And the first thing we want to do is we want to get all of the assets and list them out. Now, I would like for you to recall that assets are listed in order of liquidity, meaning how quick can I turn these assets to cash. So our most liquid asset is always going to be cash. So we're going to list cash first, and that is $6,873. Okay. Then we're going to list accounts receivable because it is considered to be a cash equivalent. And I'm going to abbreviate. All right, $2,225. Then we're going to list supplies. Supplies were $980. And then land. Land was $10,000. We're going to draw a line because now we're going to do total assets. Add all of these totals together, and we're going to determine that the total assets were $20,078. And that's our final answer. So we're going to double underline it. All right. The next thing we need to do is we need to find the liabilities. There's only one liability for Mr. Jameson, and that is the accounts payable. And that total is $2,355. Okay. Once we put that in, if we had multiple liabilities, we'd add them together and come up with total liabilities. But in this case, since there's only one, we're going to go ahead and drop down to the owner's equity. We're going to list Cecil Jameson capital, $17,723. Where did I get this from? I got it from the statement of owner's equity. Oh, right here. Okay. All right. Then we need to total liabilities and equity. So we're going to do total liabilities plus owner's equity is $20,078. And that is our final answer. And now we can see that our balance sheet actually balances. Our assets, $20,078, equal our liabilities plus owner's equity, which is $20,078. Once we finish this, and we see what the net income is, was there an increase or decrease in capital, what is the total balance sheet, then we want to focus on the statement of cash flow. The statement of cash flow is a unique financial statement because this only deals with cash. And by the time we finish this particular statement, our ending cash should balance and match this cash account here. So that's the total we're looking for, $6,873. All right, let's put this together. There are three main sections of a statement of cash flow. That is your statement of cash flow from operating activities, from investing activities, and from financing activities. This relates to operations, money coming in, money going out. This relates to investing activities. Did you buy or sell large assets? This is based off of financing. Did the owner put money in? Did you get money from creditors? Did you pay them? Did the owner take money out? We then determine if there was an increase or decrease in cash. We put in what was the beginning cash for the month to determine what the ending cash balance is. So let's list all this information in here. Now, cash received from customers. We need to go and look at the transactions and determine how much did the customers actually give us in cash. And we can see that on transaction A, customers gave us $3,928. Then on transaction G, customers gave us another $3,000 or paid us. Doubt seriously they're giving it to us. So we want to list this. Cash received from customers, $6,928. That's the $3,928 plus the $3,000. We need to deduct cash payments for operating expenses. Now, this is going to be any money going out to liabilities, and it's going to be expenses that are paid. So we have liabilities that we paid out, $1,055. You can see that in transaction B. We paid the rent of $1,200 in transaction D. And then in transaction I, we paid a total of $1,500 out to expenses for a total of $3,755. So we're going to put a parenthesis indicating that this is a negative number, $3,755. And then we're going to draw a line. The difference between these two is what we consider to be the net cash flows from operations. So $6,928 minus $3,755 equals $3,173. That is our net cash flow from operations. In this particular example, we did not have any assets that were bought or sold, so we're not going to do anything for the investing activities. So we're going to drop down to cash flow from financing activities, and we're going to enter in the cash received from an owner as an investment. For the month of July, the owner invested $3,700. We're going to deduct out any withdrawals by the owner, and in this month, the owner took out $1,000. So we're going to list $1,000 as a negative number. Right, draw a line, do a calculation, and then our net cash flow from financing activities is $2,700. Draw a line for another calculation, and we're going to determine whether there was an increase or decrease. And what we're looking at here is there was an increase in cash of $5,873 for the month. We're going to add in the cash at the beginning of the month, and if you look back at the transactions, you see that the beginning balance for cash was $1,000. Draw another line, and now we're going to add these two totals together to determine that the ending cash flow as of July 31st is $6,873. And we're going to double underline that because that's our final answer. So ending cash flow as of July 31st, $6,873. I can reference check this to the balance sheet. We see cash has $6,873. So now I know I have completed the statement of cash flows correctly. This concludes the financial statements examples.